Good afternoon. How are you?
Afternoon, I'm good. How are you?
Aye, absolutely fantastic. Raring to go, as usual. Wealth Creation Job been talking about it all last week and all this weekend, and it's all about sensitivity analysis today. And we'll talk about that a bit more in a minute. Now, the reason we're going to talk about sensitivity analysis in a wee while, we're going to cover the news first. So for anybody out there, if you're watching or listening in on the podcast, we're going to talk about the news first and what's going on, and just generally in the week itself. If you've got anything to comment, please feel free to put something in the comments. If you've got anything to say or you've got any questions you've got as well, please feel free to comment as well. We'd love to get some likes, some loves would be absolutely really appreciated, and some shares would be amazing. Probably going to put in wee incentives for that, for people that actually become sharers of what we do. Maybe Amazon vouchers and stuff like that for these people. But we're not going to tell anybody. We're just going to do that nice and randomly to people. So we're not going to make any major announcements. Anyway, so this leads me to believe sensitivity analysis, and I'll just, before we come on to it, on the part of last week, it was about risk assessment, wasn't it, Richard?
Yeah.
Risk assessment, probably risk. Sensitivity analysis is just a slight manoeuvre on that, and I'll tell you why. And it covers things like pension retirement, it covers things like stocks and shares, it covers things like gold, it covers crypto, it covers everything like that. This is what it's modelling, it's financial modelling, in order to understand where you are and how the impact of anything that happens outside of your control can actually impact on your financial situation, which could potentially stop you from retiring. Happened in the credit crunch. But we'll talk about that a bit more in a wee while. So what's been happening in the news?
Yeah, I mean, just to touch on what you're saying, Jim, as all part of the whole planning process and things, especially when not just property investment, everything kind of does apply to, but I've been reading articles in the last week. I mean, it's been around for a wee while now, but there's been talk about people selling up their portfolios with all the changes in legislation and obviously increasing bills. And there's been
that's really true.
Well, this is why I thought I'd bring it up, because I think I mean, fair enough. Some people, depending on their situation, they might be in a position where they're like, right, I need to sell up now, but I don't think that people should do it too hastily and give up on their investment, especially if they spent a lot of time building that up, just because there's a few changes. And I think it comes back to planning as well. If you've planned out your investment and your portfolio and protect it by doing, like we spoke about last week, risk analysis, and what we're going to speak about today, sensitivity analysis, then you could hold on to your investment and don't just discard it and sell up and move on when I think that it's maybe a hasty decision for some people. But I see all these articles and I've seen people pushing. It's like, oh, well, we could sell your portfolio. We could sell it in 19 days, and it's kind of it's opening that opportunity for people just to sell up. Good opportunities for new people like yourself who are buying and things. But
Richard,
I think it's
that selling 19 days and completing 28 days is absolute tush.
Yeah,
because, there's no way you can ever do that, because even a solicitor can't get that over the line in 28 days.
Just going to see how they're getting over.
Especially if you've got a bank in the process. The bank's going to require all the requirements. They're going to have due diligence. They're going to have their own surveyor going out. They're going to have their own legal team putting securities in place. That is going to take a long time. You know that, because I've just done that with 21 of my properties. So that's going to take a huge amount of time for anybody to say, oh, we could sell your portfolio within, or we can take on your property within a certain amount of time. I mean, I couldn't care less what they say, but we could do that as well. It makes no difference. But we probably have a market who are actually got people that could actually potentially pay a bit more than what you would have normally to these people that actually go online and advertise, like property buyers and stuff. I wouldn't be entertaining people like that. I know most people, most of the people that go that route think they're convinced by the story that they hear round about them that the information that they're getting is completely accurate. And I mean about the property market and how it is, and also potentially the valuation of the property. But what the most of them realise is once they come to someone like us, and then they hear what our story is, it's like, wait a minute, that's not what I've been listening to. Because it's like, I've got no agenda here. I'll just give you the truth, and I'll point in the right direction of where you need to do. Because if you've got a portfolio outside of this area, potentially I possibly won't buy it, but I tell you what, I'll be able to tell you the right advice to get the best price for it from the right person and point in the right direction for the people that actually you should be using to do the job. I get nothing out of that at all for doing it. I get no money from you at all. I get no money from the people I refer to, but I think it's the right thing to do because I know there's people out there being taken advantage of. That's what annoys me the most.
Yeah, and I think you really need to be careful. And it's amazing how many. I mean, obviously, that's not even what I was looking for. I was just looking through. I mean, I read things like Landlord Zone and things where you get a lot of, and you see a lot of it filtering through. And people will be maybe in a position where they think that they're maybe struggling. Obviously, like I say, costly things and the ever-changing legislation with lettings and things. And some landlords might be like, "Look, I'm ready." But it's not always the answer. And if you are at that position, make sure you do it properly and get the right people to help you do it.
This is quite interesting. You talk about the landlords facing increasing bills. This actually does come into sensitivity analysis.
Yeah.
This is a classic example. Mortgage rates have increased. Exactly the same thing. It's all about sensitivity analysis. How will that affect you? Continued additions to property compliance to contend with. But that's normal recourse. I mean, if you're a good landlord anyway, and you're above, above what everybody else is doing, and you're doing what's meant to be done, then these new compliances that come in are only legislation for the people that are not doing that, which is the very small minority of the landlord population that actually do that. Hence the reason why it really shouldn't have an impact on you at all. But there's this thing about drinking their Kool-Aid. The people that are actually beating this drum and actually getting people to beat the drum with them and be their tribe, so to speak, and have their thinking as well. And the fact that this is going to cause a huge problem. It's not, because you're already complying with it already. So it's all it is. They're just ratifying it by putting it in legislation to get the people that are not complying with it to actually comply with it or get out of the market. So when they're going about a landlord selling up because of this, that's the landlords that aren't complying with it anyway. Bye-bye.
Yeah, because they've suddenly got to a point where they've got all this work to do to make the properties compliant when they should have been compliant in the first place. And if there's any small changes or additions to compliance legislation and things, if your property is already compliant, it's going to be a small addition to bring it up to code. If you're
classic example, here it is, Section 21 getting done away with, and so the default eviction, you're not actually allowed to take it back just for taking it back now, and that they're going to do away with Section 21 in England. Now, we've done away with ours, the no fault eviction, several years ago, and how has that affected us? Well, it's not really anyway, because we've always had a ground. One of the grounds on which to evict somebody, whether it was rent arrears, whether it was taking the property back because someone's moving into it of our family, or we're selling the property. That is generally the main ones you do. And if the people that were worried about the Section 21 no fault eviction actually thought about how many times they had to fall back on that, they would actually go, well, none actually. So what does it matter? That's no reason for selling up.
Yeah, we touched on that a few weeks ago in the show, and obviously that's coming into play in England. But it's been up here for like you say, several years now. I think it was 2017.
Up in the progressive nation of Scotland.
But it's fine. I mean,
funny how you're always first to lead and blaze the trail for everyone else. The Scots, the wee small nation that invented most things in the world. Somebody actually challenged me on that at one time, and I actually had somebody from England that actually went, well, to be fair, and he actually posted something on what have the Scots done around the world. And it reeled off every single thing that the Scots have invented, and the boy went, aye, okay then. So, we're talking about promotions as well. Is the right decision to hold on to your investment? What do you think on that?
I mean, unless you're in a position,
hold on to your investments, what would you give someone the advice? If someone says, is it the right decision to hold on to your investment? What advice would you say to someone about that?
I would definitely say it is, and that's why I've chosen to bring up this topic up today. I think that if someone's in a position financially, I know somebody, an investor at the moment, who's in that position and they are having to sell up. And that's fine, and that's because of their individual situation, and they've looked at that, and really it's the best thing for them to do. I think if you're on the fence and just a wee bit wary about, just because like all these changes maybe to the costs of bills, or if it's down to compliance, find the right people to manage that for you and hold on to your investment for the long term. That's what I would advise somebody to do if they were currently in this situation, and maybe getting pulled in by these promotions that, oh, we'll get you the best price and sell your portfolio in a matter of days, which is ludicrous. Don't get drawn in by that, and speak to the right people, and hold on to your investment.
I think you've hit the nail on the head. I think it's all about, is it the right decision to hold on or to actually sell? In terms of property, in terms of anything else, I think it's actually getting the right advice from the right people, the actual people who are knowledgeable in that field, in that expertise of field. I mean, if somebody came to me and says, should I hold on to my crypto? I have no idea, because I've never dealt with that market. Should I hold on to gold? Should I hold on to silver? I have no idea, because I'm not interested in that. It doesn't pay me to wait while it goes up in value or goes down in value. I still get paid to wait even though property goes down in value. It has no effect on me. It goes down in value. I still get paid to wait though. Well, it goes up and down. Well,
that's what we spoke about in the midweek show, you and I and Perry. And we also touched on compliance and legislation and things as well. And if you are a landlord or investor, you're doing things yourself and you feel like you're drowning in compliance and legislation, law, or any other aspect of lettings, then get somebody to do it for you. Get somebody who knows what they're doing with it to do it for you. And it'll alleviate that level of stress or fear that you've got about doing something wrong, and ultimately save your time, which, as we spoke about before, is ultimately the most precious thing.
Yeah. Okay. I'm going to talk about sensitivity analysis.
Yeah.
Go into a bit of detail. So what is sensitivity analysis for people out there? I briefly touched on it before. It is financial modelling. Now I could go into huge emphasis, but you can look up on the websites and stuff like that. It's a financial modelling process on an easy scale, on a simplified scale. It's actually to look at what you've got right now and actually realise the impact that could possibly have if anything external outside of your control actually influences that what you've got. Now, it could be anything. It could be things like, it could be gold, it could be silver. I mean, what happens if the price of gold changed? How would that affect you? What happens if the price of silver changed? How would that affect you? What happens if crypto changed? What happens if crypto goes down? Well, I think it's down to 50%. What happens if crypto dropped 50% and you just put your money into crypto and you've lost 50% almost within a month? I'm not saying that's what it is, because I don't keep an eye on it, to be honest. What happens if that happens, and how will that affect you on a bigger scale? And what are your plans for the future? Is it the fact that you can wait for a long time for that to come back and go back on form? Is it also the fact that you've only a short period of time? Are you in for it for 5 years? Are you in for it for 10 years? Are you in for it for 15? Are you in for it for 20? What also happens if, God forbid, that's the end of the road for you? You walk out the door and all of a sudden, and then that's you done. What happens? And a lot of people say, well, if I'm gone, am I caring? It's like, but if your intention is to leave that for your family and for your family to provide, what have you put in place to make sure, for example, if I went, and that was it, and then you were gone, and then all of a sudden inheritance tax dives right into your portfolio and wipes 40% off just like that? How would that affect things for you and your family? Would that force you into a position where everything would have to be sold from the bank? Because you've maybe got borrowing on it, and therefore the bank has to then say, well, you've got borrowing on it, the value's dropped, or you've got inheritance tax to pay, so then therefore we're not going to finance that for you, we're not going to let you do that, you're going to have to sell some of the property. And then what happens out of that is, well, what about the capital gains? What about the taxation implications? What is the knock-on effect of that happening? So this is all about, small things making a fundamental difference later on, based on things that are outside of your control happening.
So all these influencing factors, it's taking these all into consideration, and then looking at if these change, or if they change slightly, or if they change drastically, how are they going to affect me? And then basically, and safeguard for the future as well.
It is, but you can get paralysis of analysis.
Yeah.
So be careful that you don't get into the whole model situation where it's like, oh my God, I'm just like completely filled my head and I'm not really sure if I do this or if that happens or if that happens, how that affects me here. And then it comes to the point, and then you just go, this is what, you know why I talk about this, because I've done it in the past. And then you just go, oh, to hell with it, forget about it. I'll just leave it as it is, because you've thought about it so long, and you've thought about all the different things that could happen, and you've got complete paralysis analysis of the whole situation. But all you need to do is pick out the real key points, the things that could actually happen, it definitely might happen, and then think, how does that affect me in an isolated position? So no, in other words, I mean, what's the probability of interest rates going up, rent controls going in place, and something, something else happening at the same time? Very, very minute, and that's risk analysis. That's not sensitivity analysis. That's risk analysis, and the probability of all these things happening together is very, very remote. Whereas one thing might happen on its own. So how will that affect you if that happens on its own? Maybe does that make sense, Richard?
It does, and it kind of marries up with what we've been speaking about in previous shows: stress testing, risk analysis, sensitivity analysis. Today, they are all different, but similar in the prospect of what you need to do and go through that process to ensure that you've got a viable investment portfolio that's going to be safe for the future. And like you say, if you're looking to pass that on to your family and things like that, then you really need to do this to make sure it's going to have longevity.
Yeah. Well, I mean, here's let's take some examples, okay?
Yeah.
Some examples are a classic example right now. Now, this is not me giving financial advice. Let me point out, it's actually in this post as well, because at some point, some person might say, "I took your advice and all this." So I am not a financial advisor.
That's your disclaimer.
This is just what I do. So when I took out pensions for the kids when they were first born, yes, you can do that, by the way. I then worked out that, I tell you what, I'm going to put them in UK equities. Now, UK equities in the investment world, and if you look at, for example, Standard Life and that, they class UK equities, investing in UK equities, as a high risk category. They're like, they go from a scale of 1 to 7, and UK equities sits at 6. Overseas equities, in other words, stocks and shares overseas, sits at 7. It is really high risk, volatile. So high risk means it could go up or down, depending, and you're not really sure if there's going to be a dividend paid or not. So that's how UK equities is. But over the long term, UK equities over the last 20 years has paid out round about 4.5% in dividends of the top 100 FTSE. So the top 100 FTSE companies has paid out 4.5% UK equities on UK equities and dividends, and it has actually gone up over the years. And with the tax back on that, which is the lower rate above, so you get up to the lower rate. So if you put 2,880 in for a child's pension at the maximum in the year, they will top up to 3,600. So they give you free money, effectively, which is the tax. Even though your child doesn't work, the child gets the tax benefit of that. So then over a compounding, and we've done it on a previous show, the compounding of wealth. In the beginning, it doesn't look much, but when it starts to compound towards the end, in the 40 or the 50 years for retirement, it's like astronomical. It is the 31 pence. It is the 1 pence doubled up for 31 days.
Yeah.
And the first couple of days, it's like 1 to 2 to 4 to 8 to 16 pence to 32 pence. Like, that's 5 years so far. You're at 32 pence. But then you at 30.
All of a sudden,
at the 30 days, it's 5 million. At the 31st day, it's now 11 million. So in one day on the compounding wealth at the end of it, it's a lot more. But I put it in UK equities because there is no finite plan for them to retire soon. Whereas in a UK equity situation, you would think to yourself, wait a minute, I'm probably going to retire in the next 5 or 6 years, or maybe even the next 10 years. Maybe I should be speaking to a financial advisor to maybe say my risk is a bit too high now because of the volatility. Here's the sensitivity of it. If the volatility of the market, for example, the credit crunch came along, what's happened, it almost wiped everybody out overnight in terms of retirement. A lot of people actually came to me in that time, and I remember them saying to me, my pension fund is invested in the high risk categories. Therefore, I'm at a point now where it's dropped so far, I actually can't afford to retire. And that was in the credit crunch. So that's why sensitivity analysis is actually quite important, because it's how sensitive are your plans. Here it is there. How sensitive is this to your plans if anything like this changes?
Yeah.
So normally what happens in financial services industry is when you've got things in pensions, the financial services advisor usually comes back to you and says, maybe you should have a review and possibly be actually moving your investment down to a lower risk category. I think the lowest is UK bonds. Because bonds is like savings bonds. It's like you put your money in the bank, but it's in bonds, and it gives you a fixed rate return every single year. So it's like, but it's not much. But what it does do is it guarantees your investment then, because it's locked in, and it just says, okay, we're guaranteeing your investment. It's locked in now. That money's there tight. It's like, you know what it reminds me? It reminds me of Deal or No Deal.
Yeah.
You know, the banker.
With the boxes,
like,
the
you
banker.
can take the money now. We've got this box. We've opened the box. You can take that money now, and you can take it at that value, or you can risk it. Here's the risk bit. You can risk it on the premise that you might get a larger value, or you might end up with 1 pence. And most people are like, whoa, well, wait a minute. Well, that's kind of where I wanted. I'm not going to be greedy. I'm quite happy because I can get what I want from that money. So they take it. But the other person, like, let's go for it. And that's the high risk category. They then take the risk of the fact that they could actually get the 1 pence, or they could end up with I think it was 250,000. So that's sensitivity analysis, and as you put it, and we extrapolate that in this similar example to how people look at their pensions. How does that affect property? Let me share this. How this affects in the property market. I'm going to share my spreadsheet. I'm going to walk through this now. Most people
in that scenario, Jim, you're talking about that, and obviously comparing it to like Deal or No Deal and things, but you've also at that and the same at the same time, you've got the right people there. You've got your accountant who obviously knows what they're talking about. They should, and you've got the right people advising you what maybe you should or shouldn't be doing, and that's always important as well.
Yeah. Here's how I love what I'm doing now. See this interest rate? That's about 3.5. We know that.
Yeah.
From previous, and 4% and all the rest of it. Okay, so we don't need 4% anymore because we're not buying anything. We're actually sitting with what we've got. So the 4% wouldn't apply to that anymore. And so we've bought a property. Here's a great one of sensitivity analysis. We buy a property, say in St Andrews, right? We buy a 2-bedroom, sort of 230,000, 2-bedroom flat. Now, what does a 2-bedroom flat rent for in St Andrews, Richard?
You'd probably somewhere around about 1,100, 1,200.
1,100, okay.
Yeah.
Now, we're going to mortgage that in, and at the 25% loan to value, provided you get that. Actually, I'm not really sure if that rental cover would cover 75% loan to value, but we'll assume it does. And then you're getting a 3,200 return net on there. See that at the bottom line there?
Yeah.
Just in here, see 3,200 there, and it's a 19-year payback. You've got 60 grand in. You're 2 grand because you're assuming it's ready to go. It probably will be ready to go because most properties in St Andrews at that level are ready to go because it's mainly a student-led market.
Yeah.
So why do we talk about this in terms of sensitivity analysis? Well, here's where you are right now. Now, the things in sensitivity analysis to think about is, first of all, how would interest rates affect me? And so how would interest rates affect me in this scenario? So if interest rates, because my borrowing is actually quite high in this one property, would interest rates, if it went up to 6%, cause me a problem? And you're absolutely right, they will. See how it does that? You're now losing money in that scenario. So you can't afford interest rates to go up too much in that scenario. Now, if you're locked into a fixed rate mortgage, you might find that the variable rate, and maybe when that time comes out, is sitting around about 5% just now. So if you're sitting if it comes out at 5%, you're literally just breaking even.
Mm-hmm.
Okay, so that's in that situation where you've bought at 230 grand. I'm going to take a note of this. You're at 5% interest rates, and then you're almost tapped out.
And you've only got one property.
1,100. Aye, one property. So that's quite sensitive. And so we've assessed the risk previously about where risk is, but this is now sensitivity. How does this affect the bottom line? And it is actually quite sensitive because if you do 0.5%, it's like, oh my God, you're breaking even now, and you're just in loss making. But would you imagine if you have 1 month empty, you're losing money.
Yeah.
See how that jumped here, that 1 month empty. From 247, 1 month empty, you were at £1,000. You've lost 800 quid just like that. Just so that's
a really sensitive situation to be in.
Yeah. So we could change that back again, and then what happens if you change your rent? What happens if the rent, almost like the government turn around and say you're only going to get a set amount now? All of a sudden you're only getting 900. Look how that changes. Look how that changes from 3,000, right, to 1.5 grand, just written off like that.
Yeah.
So you're 1.5 grand down just because that had a slight decrease in the rent. The government tried to put in that. Now, let's look at that again, the same scenario. You've got 59,000 there and here, so down at the bottom. So we'll assume 59,000. Now, let's take the properties at 110,000. Now, you can get two of them more than likely. See, you've got the 59 still invested?
Yep, so same money in.
Yep. And what would you be getting for 110? How much would you be getting rent-wise for 110,000 property? That would probably be a 3-bedroom in Glenoffice. A
3-bed, we'll play it safe at 600, but I am getting 650 for them just now.
Yeah, you are getting 650, so we'll say 1,300. Actually, 650 we'll have to put in there. Yeah. It multiplies it up. See how that's changed? Now, the profit's changed, okay? I mean, it's significantly more than another one, but we put the same money in, and that's a different scenario. But what would happen if, again, we changed interest rates to 6% in this scenario? Look, you're still making money.
Yeah.
See how the sensitivity isn't there anymore. It's less sensitive to anything. So you can go to 7% in that example. So 3.5 again, we change that back. And then we also change to 11. So 11 months, and then you're still making money. So see how that doesn't have as much sensitivity to it. Plus the fact you've got two properties there now. So the likelihood of two of them being empty at the same time is probably pretty remote, isn't it?
Yeah. Yeah, you're not going to have both of them empty at the same time. Yeah,
the other clear thing as well is you've got an interest rate there. See the 481 interest per month on the borrowing.
Yeah.
Now, the reality is, more than likely, what would happen if you had to cover that interest every month because the property was empty? See, in the scenario when we looked at this property, the 230,000 at 1,100. We looked at that. Imagine you've got to cover a mortgage. If anything does happen, look at pandemic. Imagine the mortgage there, 6,000 you have to cover.
Yeah, it's a lot.
Where would you get that money? Where would you get overheads to cover? So there's overheads as well. I mean, this is what I always say about, if you do use a letting agent, that's fine. But always remember, you could actually get rid of the letting agent if you need to and do it yourself, if you really have to, in a situation. And that's
just going to say, in a financial situation like that, that may be your choice.
Yeah, self-managed. Take it back. You take it back if you really have to, and you do. And then you could basically take about 15% off of there. So there's another case where you could actually look at that sensitivity in terms of what you're doing. So we'll change back to 1,100 for the 110,000 for the two properties, and then we'll go back to the 650. And then, again, look, we've brought that back to 11 payback, 11 years instead of 19 years under the previous example. But it's the same money that's getting invested, remember. And then what I'm saying is here, imagine if one property went down, at least, because the mortgage here is 5,000. So basically, each mortgage is about £3,000 a year.
Yeah.
So if one property went down for a year, at least another property would be looking after it. That'd be a 6-month occupancy. Maybe because you've got two properties there, and if both of them, if one was empty the whole year, one of them would still be filled, so 50% occupied.
Yeah.
So therefore, you'd still be breaking even under that scenario, if you had that. Whereas under the other scenario, if it was 50%, you'd be screwed. You'd be out of business.
Yeah.
So there's another way of spreading risk to be less sensitive to volatile changes. What happens if the bank decides that you've got negative equity because there is a crash, and then they want you to pay some of that money back to bring it down to the respectable to the level that they should? Because I think a lot of banks have actually written that into their contracts now. I have it written into mine that the loan to value should be at least 40%. So or 60% loan to value. So I have that written to mine. So if there's a crash later on, how am I going to, and it maybe is a 10 or 12% or a 20% reduction, am I going to be able to find that 20%? So that's what I factor in. Well, have I got that 20% just in case, or can I actually mitigate that position? And that's another way of financial modeling I use to say that, if that did change and we did have a credit crunch, would I be able to weather the storm of that if that comes across right? So it is all about weathering the storm, and sensitivity analysis actually comes into that. So it is actually affecting that again. So interest rates could move a lot higher in that scenario. What happens if a rent, for example, again, rent controls come in, it comes to 550. Then again, in that situation, that's me got 6 months occupied, by the way, so I could change that again back to 12. And then I'm still fine. I've still got 17 years payback. Now, that's the rent decreasing, but maybe because of rent controls, and I'm still less of a payback than the previous one. So again, I've got a lot more leeway built into there where it's not as sensitive to adjustments to anything that could happen outside of what I'm doing. Let's take another example. Let's take this to 4 properties, and we'll take it at maybe at 80,000 each, because that is still entirely possible.
Yeah.
No, we can only get 3 at that for that same, 66 or thereabouts. So we can get 3 at 80,000. And then the rent on an 80,000 property, 2-bedroom flat, 500.
Yeah.
Okay, so we're sitting at 500. Again, let's look at the sensitivity of that. We are talking about 7% as before. Oh, bang on the money. Look at that. That is weird, eh? That's the first time I've ever had that. Bang on the money. 7% breaking even. But you still have a lot of leeway in there, because if you take 15% out of there because you self-manage, you've got 2,700. Now watch if you're self-managing where interest rates can go. Let's look at 10. We're struggling. Let's look at 9. We're almost there. Let's look at 8.5. Hang on, 8.5. So if you had to, then you could, interest rates could go up to 8.5, and you're still okay to cover yourself if you're self-managing. Now, who's to say you're going to spend all these overheads? Especially if you bought 80 grand. I mean, a 2-bedroom flat at 80 grand, Richard, would be mint condition, wouldn't it?
Yeah, if you're getting at that price, it's going to be ready to go. So you're not going to have a lot of overheads to
You're not going to have a lot of overheads, no. The only person you need to worry about is the mortgage getting paid if it goes up. And this is this is less sensitive than the other scenarios. The other scenarios, we were topping out at 5% in the very first one, and we were losing money at that level. And then when it went down in rent, because maybe rent controls came in or something else happened, or there was an oversupply of property, then we still were in a difficult position. So again, we're coming back to saying as long as that's covered. So this we're being quite sensitive, quite prudent about where we are in terms of the numbers. If occupancy rate dropped, where are we again, Richard, with that 3.5, just to keep everything the same figures. We were talking about 500, we're sitting at that. If occupancy rate dropped, say one property went down out of the 3 for a whole year, we'd be sitting at 66% occupancy, which is round about, what's that, 8 months.
Yeah.
We're still making money. Still making money. So 8 months, one property goes down, the whole year, we're still okay in that scenario. If interest rates went up at the same time at 5%, we'd just be breaking even. See how less sensitive that is?
Yes, yeah, definitely.
But yet it's the same. It's almost the same amount of money invested. And if if the rent went down to 450, for example, would still be okay in that scenario. And that's the rent dropped 10%. Because it was on 500 and it dropped 50 quid. I mean, if you dropped 10% of the other one, then you were actually losing money. When you dropped 10% of 1100, you were taking off around about 100 quid. You were down to 1,000, and you were actually on the point of losing money or breaking even. In this scenario, you're still making money. And it's still the same amount of money invested.
It's really, It's really not putting all your eggs in one basket, basically, and spreading it out across several properties is obviously reducing your risk of being susceptible to these sensitive changes. Because if it does occur and doesn't have effect on one property, you've still got the other ones running. Do you know what I mean? Or they're all still running to compensate for that.
I get it completely. This is what I've been doing for years and years, and I've modelled this over the years and worked in this way every single time for that reason. Because and that's why I often say to people, it's like before I start the journey, I know the answer.
Yeah.
And it's actually making sure I've got the risk covered, and I've also got the sensitivity covered as well. The volatile bit, in terms of planning, in terms of where it is, so if interest rates go up, I don't need to worry.
Yeah.
If occupancy rate drops, I don't need to worry. If rents drop because of rent controls, I don't need to worry because everything's planned on these things. But you see, the amount of investment money I actually generate as a result, because I'm doing this, I'm actually generating a lot more than what everybody else is getting based on higher investments.
Yeah, and I mean this sort of planning and due diligence at the beginning will pay dividends as further down the line, when instead of maybe approaching it with, "Oh, worry about it when it happens."
Hit the nail on the head. It is dividends. Now, what I would say as well is when it comes to things like, for example, gold, right?
Yeah.
Look at gold prices. If you can factor in, if you've got gold and you rely on that money for, possibly saving your money, or you've got Bitcoin, or you've got silver, or you've got any of these investments. By the way, these don't pay you while you're actually going up and down in value, whereas property does. Stock market doesn't do that as well. Stock market doesn't guarantee a payment, whereas you're more guaranteed a payment in property investment because you've got a tenant in the property, which is less likely to move because everybody needs a roof over their head. No, everybody needs stocks and shares over their head because that's not used to anybody. No, everybody needs an investment in stocks and shares because it really is just people exchanging money to buy each other's shares in order to see if they can get a return and play a market. It's effectively a less risk-adverse way of gambling on predictions about what future companies are expected to make. And there's strict requirements by the stock market in order for reporting about what companies should be saying and when they should be saying it. Classic example is when I was working with, I think it was Havelock Europa. So when I was working with Havelock Europa, when they knew potentially there was they forecast for the year. So Havelock Europa forecast for the year, and they tell the market where they expect and what they expect to make. Everybody jumps in and buys shares based on that principle. But there is requirements at some point in time. If Havelock Europa don't think they're on track to make that money they expected to make and on their forecasting, they have to report to the stock market and say there's been something changed. We don't think we're going to make that money. Therefore, we have to put a report out to that effect. And that's what a requirement is, because they never used to do that. There was never a requirement to do that years and years ago. And what they found is they got to the end of the year and most people reported the results and they weren't making what they were making. And all of a sudden, their share price dropped like a stone, and everybody's investments were like, "Oh my God, I'm completely exposed now because I thought they were going to make this money, and I'm now in a position where I can't do what I'm meant to do because it's supposed to be for my retirement." So in order to provide certainty, the stock market put in place certain regulatory requirements to actually report to the industry and to the financial industry if there's any change to what you previously forecast. So that's how stocks and shares works. That's how the stock market works. And I don't really think there's anything to do with gold and silver and how they do that. There's certainly no anything to do with crypto. I think they just make that up as they go along, to be honest. But that's where the situation is just now. Pension planning as well. Speak to a financial advisor, somebody that's actually qualified, that can actually look at your portfolio, look where you are and what you should be doing. If you've got an accountant, a really good accountant, I usually ask my accountant to predict certain things. In other words, if I did this, or if I did that, or if I did this, how would that affect the overall outcome of this situation financially. What would I pay in tax? How much would I get in my hand? And all these different scenarios. So I know what to do in advance for what I'm doing. The other one as well is, where am I going to be before the end of the financial year, based on the numbers I'm doing right now and the predictability of income coming in, and should I actually be doing improvements now to possibly bring that tax down? The reality is they'll get you the next year anyway, because all you're doing is deferring it. Or should I actually do the improvements in next year's results to do that as well? So again, that combines with sensitive analysis based on what your thoughts are and what you want to do.
Yeah, as you talk about obviously investment in stocks and shares and things here, Jim, there's such a lot of risk involved in that, and an element of just technically leaving things to chance to a certain degree. Whereas you could plan property investment and portfolio right down to and kind of make it a fine art where you've planned things so much and you've done your risk and sensitivity analysis and things where you're not left to that element of surprise or chance or things changing, and makes it so much a better, a sound investment and a lot more of a structured investment rather than because things could change in stock markets and things, and you didn't have any control over that. You can't change that. So there is a lot of risk involved in that. Whereas property investment has, you're able to safeguard, like we just spoke about. And we speak about obviously doing multiple properties, Jim, and obviously how that lessens the sensitivity of your investment to these changes like interest rates and things as well. What's your thoughts on like area? We spoke about areas like St Andrews and Glenoffice, or even Fife as a whole. I know your own portfolio, obviously, because I look after it, is across the whole of Fife. We've got stuff everywhere.
I like Fife because Fife's completely undervalued.
Yeah.
You can see that anyway, and it's always been undervalued. It is almost a poor relation in terms of everything, but we've got a huge amount of investment coming in, over 100 million, and they've got investment everywhere else as well, but particularly in Leavenmouth in the area. But I actually see it as a really good, because when you look at the multipliers, here's the key here, the key indicators here. The average price in the UK is around about 350,000 to buy a property. That's the average price point. Now, the average earnings in the UK is round about 30,000 a year. So if you divide one by the other, you're about 11 times your average earnings to buy the average property. If you look at Scotland, it's around about 240, 250,000. So if you look at 30,000 a year again, because that's the average earnings in Scotland as well, believe it or not, you would think it'd be a lot more because it would take in down England. But it's like, it is similar to the rest of the UK, the average earnings in Scotland. So that is the multiplier is around about 8 or 9 times. But if you look at Fife, the average earnings in Fife is around about 30,000. And then when you look at the average price point in Fife, it's about 180 grand. So it's only 6 times.
Yeah.
Now, for people in Fife, they don't see it as affordable because they're living in a property right now that is the same proportionally price point as what they've got. For example, a 3-bedroom in Glenoffice is around about the 100,000 mark.
Yeah.
Yeah, a 3-bedroom in Glasgow is probably around about 300,000.
Yeah.
A 2-bedroom flat in Merchant City is 450 grand. It's like, that's crazy.
Yeah,
and that person in 2-bedroom flat in Merchant City could afford to sell that, buy a 3-bedroom property in Glenoffice, and then reinvest £300,000 in the Fife area. But somebody in Fife doesn't see that in the fact that it is actually less expensive because proportionally their property is the same similar value to only 6 times the multiplier compared to all the other property in Fife. So they don't see that at all. But somebody outside the area actually goes, wait a minute, that's good price points and that's good rental returns. I have always seen it like that. That is extremely good rental returns and it's extremely good property values. So therefore, to get these returns, you're actually investing less money on a buy-to-let mortgage for a deposit to buy a property at a lesser price point. It actually gives you a more attractive return. Plus, you're spreading your risk. As I'd said, that's the 1 in 3. The St Andrews, like, I'll just buy 1.
Yeah.
And then it's like, no, I'll buy 3 for the same amount over 5 at a different level, but make a higher return and also spread my risk and have it to be less sensitive to any volatile changes it could influence us. The classic is the property market in terms of if the prices drop. The prices won't drop. Even Zoopla's predicting a 3% increase this year, whereas I think in Fife, overall, I think Fife's still going to go up because of that multiplier, and because more and more people are starting to invest in Fife. And I don't mean invest as in just buy property in Fife as second homes. I mean actually invest in Fife as in buy it for an investment and actually make money and provide a home for someone, buy it for service accommodation, for tourism, and actually keep it filled all the time. So therefore, supplying jobs to the local economy, because there's people changing there all the times, and they're buying, and they're visiting the area, and they're spending loads of money in the area, so they're creating jobs, they're creating wealth, they're creating prosperity, and also people coming from outside to actually live in Fife, because they're thinking, well, flipping heck, that's a different price point compared to everywhere else. I could be a millionaire. It's like I could sell my 2-bedroom flat in London, move here and buy a 2-bedroom flat in Fife. It'll not be the same as London, clearly, but it's the same.
Yeah.
It's the same floor space. Think about that. The only difference is location that makes the difference in price. You could have the same property, put that property in London, and it'll be a totally different price point because it's in London.
Yeah.
But if you don't need to be in London now because your job isn't necessary to London anymore, because you don't need to go into work every day and commute every day, then you can move anywhere else. That makes the point. You can move anywhere else. You could release all that money you've got. You could even save all that money if you're spending a fortune on rent somewhere else. You might be spending, I know people that are spending £1,000 just to have a room. That's it. A room. Or even more than £1,000. And it's like, wait,
that's crazy.
You could have a beautiful house for that up here.
Yeah,
and yet you're still working in that same job, but you can work remotely now, and you're still getting paid the same salary. So why would you not want to live somewhere where it's more affordable to buy things and more affordable to be? That's why I think Fife over a period of time, because if remote working continues and we're allowed to continue to do it. Some of the boots on the ground stuff isn't allowed. They've got to have them back into work because they need to be there for that reason. But if you can have more people working from home, then why would they not choose to live somewhere where it's more affordable, but actually is more attractive location? Look at East Neuk.
I know, and we have seen it. And since lockdown and all the changes in people's works schedules and how they do work and work from home, we did see some of them caught on to the fact that obviously, well, I don't need to live in the city, or even like across the West Coast, Glasgow, and people like that were becoming.
Think about this even more. Think about this more. Going back to scientific analysis.
Yeah.
What would happen if you lost your job?
Mm-hmm.
See that? What would happen if you lost your job? Where would your buy-to-let portfolio be? Are you just? This is a classic example. This is what I hear. This is what I used to hear a lot, and I used to tell people off for it. Oh, if I can just cover the mortgage. Oh my god. Oh my god. You're joking. You shouldn't be in property investment then, because it's not about just covering the mortgage. That is not going to do it. Because then everything happens, you're screwed. So if you lose your job, you have an interest rate rise. If there's, if you've got a mass concentration in an area, what if everybody buys in that area, and therefore they all rent, and it almost becomes ghettoized?
Yeah.
What would happen to your occupancy rate? How would that affect things? So that's another thing you've got to factor in. And will that have an influence? That's why I talk about the occupancy rate. So what happens if everybody starts to buy in that area because it's so cheap? Train station going, everybody starts to buy in a certain area, all the prices go up, which is great. But then what happens to affordability as well?
Mm-hmm.
All these different scenarios that can affect that and come into play, you've got to think about. And genuinely, the worst one is, what would happen to your portfolio if you lost your job?
Yeah.
But now, for me, I sailed through the credit crunch.
Mm-hmm.
Because, well, to be honest, I had a job permanently anyway, but I chose to actually say, I tell you what, I'll just retire. I'll give my job to somebody else that needs it. Yeah. So I was very kind to give my job to someone else that needs it. and I was able to retire. But credit crunch, I went through the credit crunch, and I knew at that time my portfolio could sustain me, because my whole living was based on my job. That was it. I never ever spent any money of the investments I had. I always reinvested it. So my lifestyle was never at that level based on that. So therefore, what happened is when I gave up my job, it was easy to because I was able to replace my income from the property that I was actually doing. So if I didn't have a job, I was fine. So that is complete risk analysis. It's also sensitivity analysis. and then I built everything else from there. So I got to a certain stage. I never got to the stage where I could replace my income and says I've given up my job. I got to the stage where I could replace my income at least 2 or 3 times, and then I gave up my job.
Yeah.
Because I wanted to keep reinvesting, but I still had to make a living in the time. So I still needed something to survive on. So I made it sure I had significantly more. So when I gave up my job, I was able to live on that, and then I was able to have money still coming in. I could reinvest. A lot of people actually just, I can just give up my job. They give up their job to have another job.
Yeah,
that's what they do. They don't realize what they're doing. That's always been in the right. I need to give up my job. It's like, no. You need to be able to give up your job to the point where you can actually replace your income, but actually have more outside of that to keep reinvesting and build your portfolio from there. Or you're just stuck where you are. You'll never go any further.
Mm-hmm.
It's like, well, I'll wait for the price of the properties to go up. Well, okay. But then you'll have deferred taxation liabilities later on. If you release that money, you're not allowed to use that money for yourself. You have to reinvest that in more property, or it's not deductible either. So again, that goes back into the dynamics of how sensitive in this whole scenario and financial modelling. So hopefully that's explained it all. And actually, I never thought I'd talk so much about this.
No, but it's, I mean, obviously, I'm following what you say, and it is quite interesting to hear, obviously, your point of view and how your experiences and things, obviously, are bringing you to be passing on this kind of knowledge. I know, obviously, we're approaching the end of the show, but we spoke about buying several properties as opposed to just one high value property.
Yeah.
So, but one thing to be careful of and avoid, and we spoke about this before, is buying high concentrations of property all in one immediate area.
Yeah, I've done that.
The same street, or even the same block of apartments and things as
I
well.
wanted to own the whole street at one point and change the name. It's like that's how megalomaniac I was. It's like,
yeah, but
it's
that's
like
something to be careful
game.
about.
It's like I want the whole street. I want hotels.
Yeah, as well. I mean, buying a lot of property in the same street, if market trends change and things, that's something that could have a detrimental effect to your investment portfolio.
Well, we had that, Richard. There was a huge implication, wasn't it? There was a time just recently where some of our properties did sit for a long time because it was all in mass at one street, and because there was an oversupply in the area, we had an effect. But it didn't really have an effect on me at all because I'd spread myself risk so much. I knew that if that was to come, I knew I was hedged for it, and I knew I would make sure that I was okay for it. So I never really relied on that. I actually forecast if that happened, I would be okay. So when it did happen, it was like, okay, that's fine. We can deal with it. I don't need to panic. Whereas other people put all their eggs in one basket and throw caution to the wind, and they've not actually done any financial modelling or anything about how they see themselves or what happens if one certain incident, if crisis management happens. I mean, what happens if baby comes along? Baby comes along and it's like, okay, attention has to be diverted there now. It's like you have to look after the baby. It's like, who's going to stay at work? Who's not going to stay at work? Or can you both? Or do we not have anybody else to look after them? So we're screwed. It's like you're at home with the baby. You've lost one income straight away. So what happens in that situation if you lose one income? How does that affect the house that you live in? The mortgage you pay? That's another way to do it. That's sensitivity analysis. You have unplanned. It's like, all of a sudden, it's like baby comes along. It's like, oh my God, we've got 9 months to sort this out. We'll need to downsize. We'll need to do everything. And you have to do that. Whereas other people are like, oh, we've got baby coming along. And the next minute, they'll leave it to the last minute. And they think, oh, one of us got to give up our job. It's like, oh my God, well, we can't afford to do that. What are we going to do now? And then that's when the shit hits the fan. So that's another way of actually looking at this. It's all these different scenarios that could happen. You can get paralysis analysis, but please don't do that. If you need to speak to anyone, then by all means, we're here. You can have a chat with. We can help you through the basic fundamentals of what your decisions are and help you give you some clarity as to where you are right now and where you want to be and show you that path to get there. It's because I've trodden that path before, several times incidentally, and I've even gone back and trod it again just to make sure it was the right path in the first place. And I've even gone back and done it again just to make sure it was the path. And I'll tell you what, it's a pretty costly exercise to do that.
I was just going to say it. That could be a costly.
I just had to prove it to myself time and time again that was the case. but you'll actually get the benefit of actually speaking to us about it and actually walking through that situation. So no matter what it is, if we don't have the answer, someone else will.
Yeah. Another quick example, Jim, and it's one of yours again, and obviously because you do have quite a big portfolio and things, and if this situation was to come around, it wouldn't be that detrimental to you, but if somebody was buying or building a portfolio and buying several flats, say in one apartment block, if there's changes to your factor fees and they shoot up and obviously everybody else in the building decides that that's the way it's going to be, and you've got say 4 or 5 apartments, how is that going to affect you?
Yeah, that's another good point. That happened to me recently, wasn't it?
Yeah.
So we had that, and then I ended up taking them to court, and all of a sudden the factor fees were halved overnight, even though I lost, believe it or no, because it's like I wasn't. I think I was just on a crusade. Of course, I tell you what, a costly crusade, just to make my point. But I tell you what, I did halve the factor fees for everybody because they actually saw sense and knew I wasn't going to let this go, and make a song and dance about it, and eventually bring it up to the residents that this was a problematic issue. So they actually almost halved the factor fees overnight, and then that saved me because I've got 4 of them. So there I was saving about 2,400 a year. So over the case, a couple of years, I'll get my money back anyway. But it was the principle and the point. I tell you what, principles and points can actually cost you money. You could be right or you could be rich, but you can't be both. And in this instance, I wanted to be right, and I certainly wasn't rich because it did cost me to be right. That's what that saying means, by the way. Just to prove my point.
But I think,
any other questions, Richard?
No. I think for me, I think today's show for me, and I think what it means to me is that if you're an investor or a landlord that they're looking to build or starting to build your portfolio and things, don't be afraid and don't be fearful to purchase. We see that all the time. People who have the fear, just make sure that you do your obviously due diligence and speak to the right people through that whole process, so that you know you're making the right purchase and you're not making good investment choices. And plan for the future. Plan for instances in the future that might have an effect on your income and how the portfolio will perform.
I think not about Fife again, because I like Fife obviously for a reason, but I really think it's a good reflection of the whole of the UK. It's a microcosm of the whole of the UK, because you've got St Andrews, which is like London, the London of Fife, and then you've got the other end, which is other areas. I wouldn't want to mention because it's not very nice to say a certain place, but there is places that are the
lower ends of the market.
But there's an in between as well. But the great thing about Fife as well, there's a lot of there's about 50% rural and there's 50% urban in terms of industrialisation and farming and fishing. And it's about 50-50. And I think that's what the beauty of Fife is. And everything was in reach, everything of everywhere else. So if you're like, I'll tell you what, I just fancy going to the beach today. You just pop along to the East Nuke. Well, we're lucky because we can just walk to the beach from here. I was there this morning, actually. I think I just like popping around the forest, and it's like, I'll have a wee walk in the forest. Yeah, have a wee dog walk in the forest or something like that. I tell you what, I'll nip across to the main town because I need my main shopping done or all the rest of it. I mean, we've got main shopping facilities where we are as well. But if you want to go to the main places, the big massive hypermarkets, you've got Kirkcaldy, you've got Carnarvon, you've got these main areas, and they're only 6 miles away. And so it's a no-brainer. If you want to go to really, if you want to get out of here, you can jump on a train, you can jump on the A92 and commute out to Edinburgh, over across to Dundee. You've got the cities are almost within 30 miles and 25 miles of you as well. So you can have a great night out. So that's what the huge benefit of Fife is.
There is. There's just such a diversity throughout the whole of Fife, like you say.
Definitely a great investment, and that's it, guys. I mean, that's a rower up. I thought we'd actually get to the investments and the rest of it, but we never.
We'll get there one day.
We'll talk about them next week. Next week, Richard, you're on the show and possibly have a guest. And that's it, guys. If you've got any questions, please feel free to mention them in the comments. As before, we're happy to answer these questions. If you want to private message us, by all means as well. And it's goodbye from him.
And it's goodbye from him.
Well done. You're learning. See you later. Bye-bye.